Hi, this is Nick Hodge with the Outsider Club. I'm sitting down once again with Stephen Dean. He's the chairman and CEO of Atlantic Gold, which trades on the TSXV under the ticker AGB and over the counter under the ticker SPVEF. We won't do a lot of background or introduction. You should be familiar with the story. This is one of Canada's newest open pit gold mines, extremely low cost. And I have to start off by saying congratulations, Stevens, on getting the mine not only operational, but exceeding your production guidance in the first year of operation, which is very rare and a feat to behold. And I think there's more to come. So first of all, congratulations and thanks for coming on to give us an update.
Thanks, Nick. Always nice to chat with you. And yeah, the team has done an awesome job of bringing the mine up to steady state from commissioning last year, and we continue to have a good outlook for 2019.
So let's talk a bit about that outlook. You've been producing from your Moose River Consolidated project, which includes the Tokoi deposit and the Beaver Dam deposit, but you've been executing brilliantly on multiple fronts, bringing new satellite deposits into the fold, as well as doing some resource expansion and exploratory drilling. Can you give us a recap of your phased approach, phase 2 and phase 3, what those were and sort of how you've executed on them?
Yeah, phase 1, as you correctly pointed out, is the first stage of operation, where we have 2 of our 4 deposits being brought into production, Tokoi, followed by Beaver Dam. Phase 2 is the expansion. Just before we move on from phase 1 is largely executed, and we're guiding, I should say, 92 to 98,000 ounces of production at cash costs all in of around $695 to $755 Canadian, which is about $520 to $566 US an ounce, and that gives us a base case mine life of around 8 or 9 years. And then on top of that, as I mentioned, our phase 2 expansion brings in the 2 other deposits, being 15 Mile Stream and Cochrane Hill, and we've been doing some drilling extending those 2 deposits in the last 12 to 18 months. That drilling is what we call the phase 3 resource expansion program, and we recently announced significant increases in resources and reserves at those 2 deposits, as well as a nice addition of an additional year of mine life to our Tokoi deposit. I think reserves increased by about 403,000 ounces. We announced that about a month ago. And what that means is that phase 3 growth has now pushed our reserves out to 1.9 million ounces and in excess of 10 years of production, which is very rare and unusual in the junior space, certainly in the gold business. And we're very proud to be at that place of development. And then, of course, phase 4, which is our targeting of our big corridor program, where we see the real potential to discover additional deposits in addition to the 4 that we have in our life of mine plan, because the whole corridor, as we call it, is essentially undrilled.
There's a lot to unpack there. I want to talk about your low costs of production and of new resource discovery. But first, let's touch on some of the highlights of the recent drill campaign. Can you talk about some of the high-grade highlights at Cochrane Hill and sort of a little bit about the new deposits you've got or new discovery you've got at 149 and why they're important?
Sure. I don't know when any of your subscribers have access to our PowerPoint screen, but in our latest PowerPoint brochure document, we have what we call a long section of Cochrane Hill, and that pretty well explains what we're talking about here. We've had some interesting high-grade intercepts below the former pit outline and to the east. They're northeasterly plunging high-grade chutes that are yet to be actually fully included in the reserve calculation that we put out a month or so ago. So there's some real potential to add there, as well as further drilling below that to define how deep those northeasterly plunging chutes might extend. It's significant because the grade is a little higher than we're seeing in the westerly part of the pit in that end of the mineralization. So economics could potentially be stronger, as well as if we are successful in outlining some more mineralization in that easterly plunging direction at depth below the current pit floor, then that pit will drive much deeper, and of course that means good things for reserves. We add more ounces to what will be recoverable in that pit.
So let's talk about the low costs, and then we're going to tie it all together on what's next with phase 4. But before we get there, let's talk about the cost. Can you talk about your two prongs of low cost? Can you talk about why you have such a low cost of production, and then can you also talk about why it's so low cost or economic for you to discover new ounces?
Sure. In my experience of over 30 years of being in this business, leading large multi-billion-dollar mining companies as well as junior ones and startups like Atlantic, is that it's seldom just one factor that drives costs. It's or low cost, I should say. It's usually a combination of factors that enable lower costs to be achieved on any metal production. The principal drivers for us at Atlantic and in the Moose River corridor is location. We're literally 45 minutes away from the Halifax International Airport, so we're close to infrastructure and a provincial capital, which means that the service providers, contractors, we don't have a camp, for example. The people, 98% of our workforce live within 1 hour drive of the mine site. That's very unusual in this business. We have a medium grade deposit. It's open pit. It's a low strip ratio of the order of 2 or 3 to 1, with the global average being closer to 8 or 10 waste to ore ratio. We've got, as I said, a 2 or 3 to 1 strip ratio for most of the deposits. We got really good metallurgy, high recoveries of 94, 95%. And of course, the final factor is this Canadian dollar. It's discounted to the US dollar at around 74, 75 cents in the last several years. And so that means that when you're selling gold essentially in US dollar denomination, you get the benefit of low cost being the discount of the Canadian dollar cost to the US dollar. So all of those things come together to result in a 550 circa all-in sustaining cash cost for our operations. Now, I think that answers the first part of your question. The second part being how are we able to sustain a low cost or low reserve discovery cost? That's partly a function of the fact that many of the ounces that we've added in the last little while are additions to the existing resource or reserve. So they're simply bolt-ons or extensions to the existing mineralization, and that always drives a low discovery cost. The other factor is that most, if not all, of our deposits and all of our targeted mineralization are within 150 to 200 meters of surface, which means that our drilling cost per meter is low, and our manpower and timing and turnaround of that drilling is lower than many of our competitors. And so in a field where there is so much potential for undrilled mineralization like this, because as you know, this open pit style of mineralization model has never been exploited in the province before. It was always underground, deeper, sort of narrow vein mineralization. We're targeting the dispersed mineralization principally, and typically it's within 150, 200 meters of surface. So that means it's cheap to drill off.
It was those low costs that attracted me to the project several years ago, or at least the projected low costs at the time, and that has bared out in reality as the mine has come online. And now we're looking forward to adding years to mine life, increasing resources, etc. Can you talk a little bit about the slide in your presentation, and I'll put up a link below this video, about how you use the Aussie model to add those reserves being funded from the mine?
Which slide are you referring to, Nick?
Slide 12.
Yeah.
Yeah. What we mean by that, and you're well studied in the industry here, and so you'd be aware that the Aussie gold producers are enjoying a better capital markets rating. Their stocks trade at a premium to their NAV. The market appreciates the capital discipline that's applied there versus North America, or at least in the last little while. And what we mean by Aussie model is a little bit about that capital discipline, but also in this slide, the context is most important in that what we're doing and what the Aussies do really well is we start off and get into business and get cash flow and generate cash and generate returns on our capital from an existing smaller, perhaps sometimes shorter mine life, and then we grow it, and we grow it with drilling, which is funded in turn by the operating cash flow from the initial startup operation. And in our case, for example, the phase one stage of our development. So we're using phase one cash flow to then go and grow our business, grow our reserve base, grow our annual production, and grow our mine life with the cash flow that we generate, versus more of a North American model that's sort of historically been, let's try and drill off as many ounces as we can before we even start production, and use, in my opinion, higher cost capital to do that, because it's an explorer development cost of capital versus a operating producer cost of capital.
Agree with that 100%. It's been smart of Atlantic Gold to take the project into production, and that's borne out in the value of the company, which I think is going to expand going forward. So let's talk about that now. What's become really important is the potential for corridor discovery. As I understood the story over the past couple of years, it's been a string of pearls model where you have Tokoi and Beaver Dam and Cochrane Hill, etc. But let's talk about leveraging the corridor and what the potential is for a corridor level discovery, and what that means to, or would mean to, Atlantic in terms of cash flow.
Right. So what we mean by leveraging the corridor is that we have a very large franchise, being we own most of the key mineralized structure extending from south of our Tokoi deposit to north of our 15-mile stream deposit. That's about 45 kilometers of the same host rocks that host all of our deposits. And it's a structural corridor. It's well mapped out and understood, but from geophysics, it's an anticlinal structure, and the ground we own it hosts the most of the axes, or the hinge zone of this anticlinal structure, which for your subscribers who aren't geologists, what that means is that it is a big fold in the Earth's crust, and this is very basic lay geology. A big fold in the Earth's crust, which is creating this anticlinal structure. And when the rocks in the Earth crust crack to and bend and fold to as part of this structural event. It creates cracks in the rocks when those folds occur, and those cracks form the plumbing for the gold mineralization to flow into, and that's the typical host structure of all of our deposits. It's a combination of these quartz veins that can contain once gold-bearing fluids, and then there's a dispersed halo of mineralization in all the fine cracks, in particularly the rock, which we call the argillite, which is like a mudstone, very soft rock, and so a very good fine conduit and plumbing system for the gold mineralization and fluids along that whole corridor, and along that 45-kilometer strike length. You could fit probably 50 to 70 of our Tukoi type deposits. And we think there's a good chance that there's certainly at least one or two, and there potentially might be several more than that, along this whole piece of ground that hosts this structure. And the really exciting thing is that up until a couple of years ago, probably closer to 3 years ago now, it was undrilled. And we've only just started to drill those gaps in between our pearls on the string of pearls that you talk about. And we've already had success. We've identified what we call the 149 deposit at the northeasterly end of our ground holding. It's a deposit. We don't know how big it is yet, but we're drilling it. In fact, we're drilling it as we speak. And it potentially could be another Tukoi. What that means for your subscribers in terms of economics is that if we were successful in outlining in that 45-kilometer long corridor another Tukoi, which is, let's say, 600,000 ounces of near-surface mineralization, open pittable at low strip ratio, similar cost to what we're experiencing at Tukoi, that could generate gold at similar costs to what we're experiencing at Tukoi, of the order of $750 Canadian an ounce, with a Canadian dollar gold price of around $1,700 or $1,800 an ounce. We have a potential margin for this theoretical discovery, the second Tukoi 2 as we call it, of 600,000 ounces at $1,000 an ounce Canadian margin. That's $600 million of potential operating cash flow. To put it in context, that's against a company with a market valuation today of only $500 million.
That's right. And so just to put a finer point on it, just finding one of those would give you cash flow equivalent to your entire current market capitalization. And you're saying there's the potential to find 50 to 70 of them. So I'll just leave it there.
I think it's unlikely we'll find anywhere near that. But I'm just saying let's be practical, and let's be conservative, and let's say we discovered 1, 2, or 5. But let's just say we discovered one. One alone would have substantial financial leverage to our operating cash flow and balance sheet.
And so given that, and given all the other things we've described over the years and in the past 20 minutes on this interview, it's no secret that you're well on your way to becoming a very successful intermediate gold producer, similar to a company like Oceana Gold, for example. And so I wanted to ask you about two things. One, I wanted to ask you sort of your current sentiments on the market. There's been a lot of M&A that start with a B, $1 billion, the Barricks and Newmonts, et cetera. And you really have two options, as it says in your slide deck. And as I've been saying for a while now, you're either going to grow this thing and become a multi-billion-dollar company, or you're gonna get taken out. Can you talk a little bit about maybe NDAs or anybody majors coming to see the project, and talk about it in context of what you're seeing in the broader gold space.
Yeah, I think M&A is certainly back on the table for the sector. And as you pointed out, it's certainly started in the bigger end of town at the Barrick Gold Corp, Newmont levels. There seems to be a lot of talk that intermediates need to do more. I think the excitement for junior producers like us is our rarity. There's only one other junior gold producer in all of Canada that we would call a peer, and that means that the supply for intermediate companies to acquire junior companies is tight, and we're sort of certainly seeing some increase in interest from some of our bigger peers to do something. Whether it happens or not now or in a year or two's time, who knows? But there's certainly a lot more interest in M&A in the sector right now. And frankly, as you know, we as board and management own in excess of 35% of the company. Now, we're agnostic as to whether we get acquired or whether we grow the company. Our objective is to generate value for our shareholders, including us as some of the bigger shareholders. So, we're not here for our jobs. We're here for shareholder value, and whether that comes from appreciation in our stock price as a result of us growing, or whether it comes from being acquired, we're agnostic.
Great. Stephen, I appreciate the update. You mentioned there's drills turning now. Just briefly, what can we expect in the next 3 months for catalyst or news flow?
Yeah, we've got a fair amount of news flow coming down the pipe. We just released our Q1 production stat last week. We'll have our financials and cash cost reports out early in the first half of next month, May. We've been drilling at 149 and 149 East for about 6 weeks or so. We'll start to see some of those drill results flowing, and we're about to ramp up our targeting of some of the high priority targets in our corridor program. So lots of news flow coming, lots of drill results in the next couple of months, and operating results.
Stephen, congrats again on exceeding guidance in your first year of production at the Moose River Consolidated Project in Nova Scotia. The execution has really exceeded much of what I've seen in my dozen or so years in the junior mining sector. Well done on you. I think there is a lot ahead, not only with Atlantic, but for the gold space in general. So I appreciate the update, and I look forward to having you on in another couple of months to talk about even more success at your project. Thank you.
Thanks, Nick.